You started an LLC to protect yourself and your personal assets. You thought your personal assets were safe until the IRS sent you Letter 1153. Now they're coming after you personally. Your house, your bank account, your paycheck are now on the line to satisfy your business's unpaid payroll taxes. This is the trust fund recovery penalty, and it's one of the most devastating weapons the IRS has. The trust fund recovery penalty. That's the topic of today's video, right after the intro.
1-877-LEVY-KING, LevyKing.com.
What's up, guys? Corey Hankerson here from Legacy Tax, and they call me the Levy King because if the IRS took your check, the Levy King will get it back. 1-877-LEVY-KING, LevyKing.com. Today, we're talking about something that terrifies business owners when the IRS pierces your company's corporate veil and makes you personally responsible for the company's tax debt. And in today's video, I'm going to show you exactly how this happens, who's at risk, and what you can do to fight it. First, let's talk about what the trust fund recovery penalty actually is. When your business withholds taxes from your employee paychecks, we're talking about income tax, Social Security, Medicare, etc. That money doesn't belong to you or to your business. It actually belongs to the government. You're just holding it in trust until you send it off to the IRS. If you fail to pay it to the IRS on time, the government actually considers it to be theft. When a company fails to pay those trust fund taxes, the IRS can assess a penalty which is equal to 100% of the unpaid amount against any person who is, number one, responsible for collecting or paying those taxes, and number two, willfully failed to do so. Let me say that again. You can be hit with a penalty that is 100% of the unpaid amount. So if your business owes $87,000 in unpaid payroll taxes, the IRS can personally assess you for another $87,000. That's even if you have an LLC, an S Corp, a C Corp, doesn't even matter. This is covered under the Internal Revenue Code, section 6672. And here's what makes it so dangerous. The IRS doesn't actually have to prove that you really stole the money. They don't even have to prove that you spent it on yourself. They only have to prove two things. Number one, you're a quote unquote responsible person, meaning that you had authority over the company's finances. And number two, you willfully failed to pay those taxes, meaning that you knew about the tax obligation and chose to pay other creditors instead. And that second part, that's where most business owners get trapped. So who does the IRS consider a quote unquote responsible person? It's not just the CEO or the owner. The IRS casts a wide net. We're talking about officers and directors, shareholders with significant control, employees with check signing authority, bookkeepers who decide which bills get paid and when. Even outside accountants in some cases can be held responsible. I had a client, let's call him Mike, who was a 50% owner of a construction company. His business partner handled all the finances. Mike just ran the job sites. When the business failed and owed over $120,000 in payroll taxes, the IRS assessed the trust fund recovery penalty against both of them. Mike said, "Hey, but I don't even handle the books. My partner does." And it didn't matter. He had signature authority on the bank account, so therefore he was deemed to be a responsible party. And here's the kicker. The IRS can assess multiple people for the exact same debt. If there are three people that are responsible, they can all get hit with the full penalty, not like a third of it. No, the full penalty. The IRS doesn't care who actually pays. They just want their money. Now, let's talk about willfulness, which is the second prong in that two-prong requirement. The IRS does not have to prove that you intentionally tried to defraud the government. They just have to show that you knew about the tax obligation and you chose to pay other bills instead. You chose to pay rent, you chose to pay suppliers, you chose to pay salary. That is what's called a willful failure. I've seen business owners who paid their rent to keep the lights on, thinking that they'd catch up on payroll taxes the next quarter. The IRS calls that willful. I've seen owners who paid critical suppliers to keep the business running. The IRS also calls that willful. Here's how the IRS actually investigates and assesses the trust fund recovery penalty. It usually starts with a Form 4180, which is the report with individual relative to the trust fund recovery penalty. complicated, convoluted name, but that's the government. An IRS revenue officer will actually contact you and ask questions like, what was your title and role? Did you have check signing authority? Who decided which bills got paid? Were you aware of the unpaid payroll taxes? Did you authorize payments to other creditors besides the IRS after the taxes were due? Here's what you need to know. Everything you say in that interview can and will be used to assess the TFRP against you. The revenue officer is building a case. They're not your friend. They're not here to help you. They're there to determine if you're liable for the penalty and ultimately how much money can they extract from you. And here's the trap. Most business owners think that if they cooperate and explain their situation, the IRS will understand. Wrong. I've seen business owners talk themselves into six-figure personal tax debt after the interview. If the IRS determines that you're a responsible person who willfully failed to pay, they'll send you a letter 1153, proposal to assess the trust fund recovery penalty. From that point, you have 60 days to respond. If you don't respond, or if your appeal is denied, the IRS is going to assess the penalty and the collection action is going to start from there. We're talking about levies, liens, garnishments, all of them against you personally, not the business. And unlike business tax debt, you can't discharge the TFRP in bankruptcy. It follows you forever. So what do you do if you're facing a trust fund recovery penalty? You have options, but you need to act fast. Option 1. You can challenge the assessment. If you receive a letter 1153, you have 60 days to file a protest with the IRS Office of Appeals. During your protest, you can argue that, number 1, you weren't a responsible person. You didn't have authority over finances. 2, your failure wasn't willful. You didn't know about the unpaid taxes, or you weren't involved in deciding which bills to pay. Or number 3, someone else was more responsible. Shift liability to the actual decision maker. I had a client who was a minority shareholder in a restaurant. The majority shareholder handled all of the finances. When the TFRP came, we proved that my client had no check signing authority, wasn't involved in financial decisions, and didn't even know about the unpaid taxes. The IRS removed the penalty from my client and went after the majority owner instead. Option 2, if you're responsible and the penalty is valid, you can still negotiate how you pay it. You can look at an installment agreement, which is, of course, monthly payments over time. You can look at an offer in compromise, which is, of course, where you settle for less than you owe if you can prove financial hardship. And there is the option of currently non-collectible, which pauses collection activity if you can't afford to make monthly payments. The key to all of these is proving that you can't pay the full amount without causing financial hardship. The IRS is going to look at your income, expenses, assets, and liability, and they're going to use all that information to determine your ability to repay. Let me tell you about a real case. I had a client, let's just call him Sam, who was the CFO of a small manufacturing company. The company hit hard times. This was during COVID. And the company's revenue dropped by 60%. So they had to choose, do they either pay employees or pay the payroll taxes? Sam chose to pay the employees, thinking that they would catch up on taxes when business recovered. The problem is that the business never recovered. The company eventually went under, and at that time they owed about $340,000 in payroll taxes. 6 months later, Sam gets IRS Letter 1153, which told him that the IRS is assessing him personally for $340,000 under the TFRP. Sam calls me in a panic. He's like, Corey, I don't have $340,000. I lost my job when the company closed. I'm working part-time. I'm only making $45,000 a year, and the IRS is going to take everything. So here's what we did. We filed an appeal, arguing that while Sam was technically a responsible person, his failure was not willful. We showed that the company was insolvent, that paying employees was necessary to keep the business operating, and that Sam genuinely believed that his company would recover and pay the taxes. The IRS didn't buy it. They said paying employees instead of taxes is the definition of a willful failure. So we opted for option 2, which is the settlement. We filed an offer in compromise showing Sam's current income, expenses, and assets. He had no savings. He had no home equity. He only had a minimal income at the moment. We offered the IRS $15,800 to be paid over 24 months. And the IRS accepted our offer. Sam went from owing $340,000 personally to settling for $15,800. That's the power of knowing your options and fighting back strategically. So here's what you need to do if you're facing a trust fund recovery penalty, or if you're a business owner who's behind on your payroll taxes. If you haven't been assessed yet, you need to get current on your payroll taxes immediately. Every quarter you fall behind increases your exposure. If you can't pay in full, you want to contact the IRS and set up a payment plan for the business debt before they start the TFRP investigation. And you want to document everything. If you're not the financial decision maker, create a paper trail showing who actually is. If you've already received the letter 1153, number one, don't ignore it. You have 60 days to respond to that letter, and that's a hard deadline. Ignoring it puts you out of the game. Number two, don't talk to the IRS revenue officer without representation. This is not a DIY project. Everything you say will be used against you. Number three, do hire a tax professional immediately to file your appeal or negotiate a settlement if the penalty has already been assessed. That's also not a DIY type of project. If the penalty has already been assessed, you still have options. The IRS is going to start levy action against you within 30 to 60 days of assessment. So you need to act now. The trust fund recovery penalty is not something you can handle on your own. The stakes are very high, and they consider unpaid payroll taxes to be among their top enforcement priorities. So you need to be moving forward on this. Look, if you're facing a trust fund recovery penalty, or if you're a business owner who's behind on payroll taxes and worried that this will happen to you, don't wait until the IRS starts taking your personal assets. I've been helping business owners in these types of situations for over 15 years. My team and I can help with TFRP assessments. We can help negotiate settlement. We can help protect your personal finances from IRS collection action. This is literally what we do every single day. Here's what I want you to do. I want you to head on over to www.levyking.com. That's LEVYKING.com. Click the link below, answer a few quick questions about your situation, and we'll help you figure out your options. Or give us a call at 1-877-LEVY-KING. That's 1-877-538-9546. The IRS isn't going to go easy on you just because you didn't know about the trust fund recovery penalty. But I can help you fight back and protect what's yours. That's it for this week, guys. Talk to you later. Bye.